Welcome to Florence. We are here in Italy and we're going to talk today about the subject of international tax planning for Italians. So if you have done anything in Italy, you know it's a super bureaucratic, crazy country to do business, and you probably don't want to do business there unless absolutely necessary. That being said, maybe you're from Italy, maybe you access the Italian market, you want to take advantage of the fact that a bunch of products that are competitive in, say, an English-speaking country or something is not competitive in an Italian country, and so you want to take advantage of it. We have clients who, this is basically what they do, right? They sell to that market. So let's talk about it. Anytime we're looking at international tax planning, we're obviously always paying attention to the three pillars of residency. So the first pillar of residency is the residency of the company. What does this mean? Okay, so obviously you're going to have to, at a basic level, have a company that's outside of the country in order to eliminate or reduce the taxes payable, right? Now, here's the thing. So Italy's base tax rate isn't that horrible, but then they add a bunch of other stuff on which makes it not good. In addition to, again, all the bureaucracy, all the hassles, etc. So there is a lot of reason why you might want to have a company outside of the country and sell into Italy. However, to do that, the company has to be genuinely tax resident. So one of the things we talk about all the time here is the difference between registration and residency, right? Lots of people will come to us and they say, oh, I have Seychelles, Belize, whatever it is that they pick, Hong Kong. And the problem is that that's not how corporate residency works. So corporate residency, as we've discussed, you can check out our content on it, is all about whose tax rules apply. And Italy is going to apply their tax rules to companies that aren't registered in Italy if certain criteria are met. Now, it turns out the Italian rules are probably some of the toughest in the world. I often talk about the Australian ones being especially bad, but the Italian ones are bad too. So if the company's registered, if the seat of the company, as they call it, the legal seat is in Italy, then you're going to be taxable in Italy. If the management and control is in Italy, you're going to be taxable in Italy. If the control of the company from a shareholder standpoint is in Italy, it can be taxable in Italy. So avoiding that is really, really important as a basic step. Now, again, what a lot of people will confuse is they'll say, hey, you know, so-and-so is running a company in Dubai and they're okay. Well, realize that it usually doesn't, you usually don't get caught for tax evasion in the first or the second year or something. Oftentimes it takes many years, and then the consequences are huge. You might think about Dolce & Gabbana. They got like an $800 million fine or something, or got in trouble for evading some in the hundreds of millions of dollars of tax and went to prison for it, right? Not good. So you don't want to be in that situation. So what do you have to do? Well, first of all, you obviously need to register a company outside the country. That's a basic. Then you need to have management and control outside of the country. That's, again, pretty normal. This means that you need the director decision-making taking place there. Now, you might also want to have a situation where you have, for example, some sort of a trust or something, because you don't want to get caught in these rules, and the Italian rules there's a lot of them, and they're tough. So you don't want to be in a situation where it's questionable, right? So ideally, the control from a share standpoint, not just from an operational standpoint, is also outside of Italy. So you could use a trust for that. Interestingly, some people will say, hey, you know, Italy is not a common law jurisdiction. So trust wouldn't be normal, but actually trusts are not unheard of within Italian law, so something to consider. Anyway, so you may want to use a trust when you're doing Italian international tax planning, or a variety of different other things, okay? So if you have the company is outside of the country, the management control is outside of the country, and the actual control from an ownership standpoint is outside of the country, now they also have this thing which is about if the principal business operations, or the main portion of the business operations, is within Italy, then that can also be an issue. So you basically don't want you don't want operations within Italy, if possible. So how would this normally work? Well, normally we would do something that we refer to as having profit centers and cost centers. So you'd have separate legal, if there's something that you're going to do in Italy, it's going to be done by an Italian legal entity at arm's length. Okay, so that would be how you would do it. You would have a company that's abroad, that company is going to make the majority of the money, then you're going to have an Italian company which is going to make, you know, a lot less money, almost as close to zero as possible, but it's going to run Italian operations. And maybe you do that by subcontracting to somebody. Maybe there's a few different ways you can do it. So if you want some advice, contact us about that and we can discuss the details with you. So that's the first step. What's the second step? The second step is, of course, the residency of the income. So this comes back to that second part, which is, hey, where are the operations? You need to have operations outside of Italy, okay? It's just increasingly we're in a world where substance is the most important thing. And if you try and set up a foreign company and you're sending all sorts of money out to Dubai or Panama or wherever else it is, and you have an operation sitting in Italy, there's a reasonable chance they're going to say, hey, you're probably trying to evade tax, you're laundering money, you're doing whatever. That's no go. You can't do that. So you actually need real business outside of the country. And again, this is why we look a lot more not at traditional tax havens. So traditional tax havens, you were in a situation where, what are you going to hire people in BVI? Probably not. So we look more at places like Georgia, we look at Malaysia, we look at places where we can get good quality labor, low costs, etc. In this particular case, you might have people located in places like Albania where people speak Italian, but they're low cost. Right now you would contract them and things like this. So where you set up and how you set that up is going to vary somewhat. However, it's important. This is why San Marino is sometimes interesting. This is why Bulgaria can be interesting, and so on. Okay, so you're going to need operations outside of Italy. So now we've said, okay, we've genuinely got a non-Italian resident company because we've gone through that process. We've also got operations outside of Italy. What's the third part? The third part is the residency of the shareholders. So again, this is where trusts might be relevant, because if you're living in Italy, doing business in Italy, etc., then you can risk triggering the CFC rules in Italy. So we get into all kinds of fancy different things going on here, but bottom line is there are rules in Italy pertaining to the tax rate as it is comparable to the Italian tax rate, and you can get these rules to be triggered. So we don't want to be in a situation where those rules are triggered. Basically, loosely speaking, what it's going to say is if certain criteria are met and the company pays half or less than half of what the Italian tax rate is, then you could end up getting caught in their web. So you don't want that. Obviously, you don't want to pay just half of the Italian tax rate. You want to pay as close to zero as possible. And so as a result, what are we going to do? Well, we're going to have a structure where we potentially use trusts to set it up, or we take advantage of various tax treaties to do it that way. Or, of course, you could shift your residency, which is the other part that can happen. So that's the basic overview of what you would do. You would say, okay, I need to make sure I set up a company. Where is that company going to be? I would look at doing it someplace where you can have real operations. So where there's low cost of labor, where you have good access to talent for the things that you need, but you also have low taxes, you also have good banking. This is going to be important. And then make sure that that company is genuinely got foreign management control, possibly utilize some sort of a trust structure to shift the ownership of it, then turn around and make sure that you actually operate it accordingly. And if you do that, if you structure everything properly, then you can take advantage of some significant savings. There's some nuances in terms of how you might want to bring the money back. There's a participation exemption in Italy. Again, it's got some restrictions on it, but under certain criteria, you can get a 95% tax deduction if you're bringing it back into an Italian company. Now, whether you want to do that is a whole other conversation. So reach out to us for some specifics, but this will hopefully give you a basic idea of what you need, and we will talk to you guys on the next video.